The cryptocurrency market is tense, like a coiled spring. Everyone's waiting for a big move, but no one knows which way it'll go. Every tick on the chart is watched with anticipation, as traders and investors alike try to read the tea leaves and predict what's coming next. The atmosphere is thick with uncertainty, and even the most seasoned market participants are on edge, knowing that a single headline or data release could tip the balance in either direction. Optimism from Bitcoin ETFs and hopes for institutional money clash with regulatory uncertainty and macroeconomic worries. On one hand, the approval of new financial products and the entry of big players signal potential for massive growth. On the other, looming questions about government regulation, interest rates, and global economic stability keep everyone guessing. It's a classic standoff between hope and fear, with both sides holding strong. This tug-of-war has trapped prices in a tight range, frustrating both bulls and bears. Neither side has been able to gain the upper hand, and the market seems stuck in a holding pattern. Traders are left questioning whether to double down or sit on the sidelines as volatility dries up and momentum stalls. But this isn't just a lull, it's a build-up. The longer the market consolidates, the more explosive the next move could be. History shows that periods of low volatility often precede major breakouts, and savvy investors know to stay alert. The pressure is mounting, and when the breakout comes, it could catch many off guard. For investors, it's a test of patience and discipline. Emotional trading in this environment is risky. Acting on impulse or chasing rumors can lead to costly mistakes, especially when the market is this unpredictable. Staying calm and sticking to a plan is more important than ever. The key is to focus on data, not hype. Watch what the big players are doing and pay attention to technical signals. Analyzing volume, price action, and institutional flows can provide valuable clues about where the market might be headed next. In the next sections, we'll break down those signals and show you how to navigate this pivotal moment. Whether you're a seasoned trader or just starting out, understanding these dynamics is crucial for making smart decisions in a market that's holding its breath. Let's look at the numbers as of June 17, 2025. Bitcoin is stuck around $66,000, unable to break $70,000, with strong support at $65,000. Ethereum hovers near $3,500, also caught in indecision. The Crypto Fear and Greed Index sits at 52, neutral. Investors are hesitant, waiting for a catalyst. Trading volume is down, signaling a lack of conviction from both buyers and sellers. A spike in volume paired with a price move would be a major signal that the market's waking up. Bitcoin's dominance is high at 54%, showing investors are sticking with the safe option. If dominance drops while the market cap rises, it could signal an altcoin season, but for now, Bitcoin leads. The market is in a holding pattern, waiting for its next cue. Whales, those holding thousands of Bitcoin, can move the market with a single trade. On-chain analysis lets us track their moves. When whales move coins to exchanges, it's often bearish. When they withdraw to private wallets, it's bullish. Lately, more coins are leaving exchanges, hinting at quiet accumulation. Long-term holders are distributing slowly, while short-term holders are jittery, selling on dips. This suggests a reaccumulation phase, not a clear bull or bear market. Whale accumulation addresses are still buying during this consolidation, showing confidence from big players. It's not a guarantee of a rally, but it's a sign that the smart money isn't running for the exits. Watching these silent signals can give you an edge. The whales are quietly preparing for the next big move. Are you? Technical analysis helps us spot patterns and anticipate moves. Bitcoin's chart shows a rectangle pattern, support at $65,000, resistance at $72,000. A breakout above $72,000 on high volume could trigger a rapid rally. A breakdown below $65,000 could mean a sharp drop. The longer the range holds, the bigger the eventual move. The RSI is neutral around 50. No strong momentum either way. MACD lines are flat, confirming the market's indecision. Traders are watching for a decisive crossover or breakout to signal the next trend. Until then, patience is key. The chart is loaded, waiting for a spark. Crypto prices are deeply intertwined with global events, and few factors are as influential as the policies set by the US Federal Reserve. Every decision, statement, or even hint from the Fed can send ripples through the entire digital asset market, impacting investor sentiment and price action almost instantly. When interest rates are high, traditional assets like cash and government bonds become more appealing to investors, often drawing capital away from riskier assets such as cryptocurrencies. This shift can put downward pressure on crypto prices as investors seek safer returns. On the other hand, a Federal Reserve rate cut would be a major catalyst for the crypto market. Lower rates tend to push investors toward riskier assets including Bitcoin as they search for higher yields and growth opportunities. That's why the market is laser-focused on inflation data. If inflation cools faster than expected, it could prompt the Fed to cut rates sooner, sparking a bullish move for crypto. Conversely, stubborn inflation could delay those cuts and keep pressure on digital assets. News about exchange-traded funds or ETFs is another powerful driver of crypto sentiment. ETF approvals can open the door to new types of investors and bring fresh capital into the market. The launch of spot Bitcoin ETFs has already brought significant new demand, making it easier for both institutions and individuals to gain exposure to Bitcoin without directly holding the asset. If Ethereum ETFs are approved, they could have a similar effect on altcoins, potentially driving up prices and increasing mainstream adoption across the crypto space. Regulation, however, remains a major wildcard. The rules governing digital assets are still evolving, and sudden changes can create both opportunities and risks for investors. Positive regulatory developments can boost confidence and drive prices higher, while harsh crackdowns or restrictive policies can trigger sharp sell-offs and market volatility. Recent political shifts in the US suggest the possibility of more favorable crypto regulations, but uncertainty still hangs over the industry, keeping investors on edge. Headlines from Washington, New York, and other global financial centers can move the market in an instant, making it crucial to stay alert to breaking news and policy updates. In this fast-moving environment, staying informed and adaptable is essential for every crypto investor looking to navigate the ever-changing landscape. Let's map out the two main scenarios that could shape the crypto market in the coming weeks. Understanding both the bullish and bearish possibilities is crucial for any investor or trader looking to navigate this volatile landscape. In a bullish breakout, a Fed rate cut and strong ETF inflows could push Bitcoin above $72,000, triggering FOMO and a fast rally to new highs. This kind of momentum often attracts new participants, amplifying the rally as more investors rush in, hoping not to miss out on the next big move. Altcoins would likely surge as well, kicking off what's known as an altcoin season, where smaller coins outperform Bitcoin and see explosive gains. This period can be especially lucrative for those who are positioned early. On the flip side, in a bearish breakdown, hot inflation data or negative regulatory headlines could keep interest rates high and spook investors. Uncertainty and fear would dominate the market, making traders more cautious and risk-averse. If Bitcoin drops below $65,000, that would confirm a breakdown, likely leading to a sharp sell-off towards $60,000 or even lower. Panic selling could accelerate losses, and confidence in the market would be shaken. Altcoins would suffer even more in this scenario, as investors flee riskier assets and liquidity dries up, causing even steeper declines across the board. Both scenarios hinge on powerful external catalysts. Fed policy decisions, inflation trends, and regulatory developments all have the potential to tip the balance in either direction. Right now, the market is coiled like a spring, consolidating in a tight range and waiting for a spark that could set off the next big move. Instead of trying to predict the future, the smartest approach is to prepare for both outcomes. Have a plan for either direction so you're not caught off guard. Watch for confirmation signals before making any big moves. Let the market show its hand before you commit your capital. The next decisive move could define the rest of the year for crypto, setting the tone for months to come. Stay alert and be ready to act. With the market on a knife's edge, patience is your best weapon. Don't chase pumps or panic on dips. Focus on the key levels: $72,000 resistance and $65,000 support. For long-term investors, dollar-cost averaging can help you build a position without stress. For traders, wait for confirmation, a strong move above resistance or below support on high volume. Keep an eye on macro events and regulatory news. They're the likely catalysts. The market's stalemate won't last forever. Have a plan for both breakout and breakdown scenarios. In crypto, discipline and preparation always win.